Ladies and gentlemen of the crypto space, we're live on a Monday, January 19th at 12:36 p.m. Today is an interesting day because over the weekend we heard obviously administration news and very sensational headlines regarding political events, Greenland in particular, and tariffs on the European Union. And that sparks what we know all too well volatility, where the general public responds in the most irrational way possible, doing the absolute wrongest thing possible. Is that appropriate language? Wrongest thing possible, or just the most wrong thing possible? And it doesn't make any sense, but that is something we must understand, digest, process, and respond to accordingly in a rational way. And basically, upon inspection, upon waking up this morning, or rather, even better, the market opening last night, the inspection that we can make is absolutely nothing happened. Nothing has changed. In fact, since the end of November of 2025, nothing interesting has occurred. So while you hear these headlines over a weekend, where you hear these headlines over the past weeks, the entire year thus far of 2026, nothing has occurred. Nothing interesting, nothing exciting from a crypto market perspective, and everything remains intact from a narrative perspective. Q2 aerodrome comes online, no, yield basis is firing on all cylinders, so price action will drive people absolutely mad, and they miss the biggest and best opportunities that are staring them right in their face. What a lot of people are probably thinking right now is to let's cram into the gold trade or the silver trade. Things are at all-time highs, record highs everywhere. People are losing their minds over gold and silver. And while that is an important inspection to make, actually that might actually be the one of the most important inspections to make. Let's pull that up real quick. If you take NQ and divide it by SLV and you zoom out, you can clearly see what is manifesting the sentiment that a lot of people have. And this is sentiment that people are feeling with regard to overall state of economics, and that plays into how much money they feel they receive from income, prices of property, prices of goods and services, relatively speaking, have been coming down. But generally, this chart is a good way to describe people's sentiment. And I mean, look how many people are on the stream. I expect it to be probably 100 or so towards the end, but we're clocking in at 26. People have lost interest, lost faith, lost their rational mind. There's no rationality left. Why? Because of this chart. This chart tells us that the financial system and the United States financial system, which plays into the global financial system, and then obviously we could look at Japanese bonds, is experiencing a catastrophic collapse of value. So you are living through the largest financial system collapse of value in modern history. There is no history that shows anything like this. I don't have, like, even if you do. Can we get silver prices? We need silver prices that date back earlier because SPX will go back earlier, but silver prices don't go back earlier. So this is beyond 2008. The collapse of the equity markets in 2008 was over years. This is just an outright collapse of relative value. No one's seen anything like this. Maybe if we change to gold, um, we need a long history though. That's surely not going to give us a long history. Let's see what we can do. Let's play around with this for a second. Okay, okay. Now let's see if we could do NASDAQ only came online much more recent. Okay, so this is the largest collapse in the S&P easily since 2019, 2007. So we're mirroring this period of time. You're living through an absolute collapse in value. I mean, the only time you have interestingly enough, what was this collapse in value right here? January of 2020. It was in March of 2020. So this really started back in September of 2020 with the repo crisis. So there's one crisis. And then you have to go back clearly to 2008 levels, Q2 2007 leading into the crisis, the financial crisis. And that's where we are right now. I like silver though, because maybe if we could get TBC SLV. I wish we had more historic silver prices because that repricing is just extraordinary. Um, Not a trust. Silver. Maybe? Come on, baby. There we go. So priced in silver, the S&P is absolutely getting annihilated. Like not even 2000, not even .com. This is much more of a starker inspection than gold. This is just wild to see. So silver was obviously suppressed in price significantly more than gold. Um, Talk about a beach ball being held underwater. This collapse is unprecedented. Unprecedented. Imagine that. Unprecedented back in 1971, back in 1930, even back in .com. And then in Q4 2019 was the start. It's nothing compared to right now. This just blasted through this monthly 200 SMA like nothing has done thus far. So as I said, the sentiment that's going on right now is because we're literally going through a financial collapse of relative asset values. This is why everyone's like, oh, we should own silver and gold, but that is cramming into the crowded trade. At some point, you get reversal and things normalize. And interestingly enough, if you zoom out to the 6 month chart, this would be an interesting level for reversal to occur. So reversal occurs in two ways. Either the price of silver normalizes and powers that be step in and decrease volatility, or the powers that be inflate the relative value of equities prices. A couple of different mechanisms the monetary and fiscal authorities have in order to intervene in this unprecedented 6 month candle in the second half of 2025. Absolutely remarkable to see. Um, okay, so that's your takeaway from of what to have about sentiment and why people feel the way they feel and they think the way they think. And we know for a fact that the way people think and the way people feel are i- wrong because the majority don't succeed in capital management. So we retain our position that nothing interesting has occurred and everything since November of 2025, we'll zoom into the daily, has been higher lows and frankly higher highs. Higher low, higher low, higher low, higher low, higher low. And we're at 93,000. So I like the way the data looks. Now, I don't speculate on the future of the data. I interpret the data as it is today, and the data tells me nothing exciting or interesting is going on in the relative pricing, the dollar pricing of the cryptocurrency market. Obviously, knock-on effects of Bitcoin pricing plays right into quote unquote altcoins or the rest of the cryptocurrency space. Yield base is down to 26 cents. That has absolutely been annihilated. A 15% drop day over day. Curve down to 39 cents. Okay, respectable 39 cents. Relatively speaking, that is not a number we're unfamiliar with. We're in territory we are familiar with. Aerodrome back down to 50 cents. Velo just keeps getting annihilated, albeit that is a higher low thus far. So take it for what it's worth. Maybe that's constructive. Maybe it's not. Moved down at 58 cents. End of last week, we were down at 55, not cents. But we were down at 55, which was a fresh lower low in the move indicator. So frankly, setting up 2026, everything is moving in what I would call a constructive direction. Things look interesting. This is what we want to see. We want to see move come down. We want to see a DXY come down. And we've been hovering. Look at this range. April of 2025. So I would highlight this entire range as what we want to see break. Where does it go from here? Does it continue downward trajectory or an upward trajectory? A reversal to the upside or a continuation to the downside? And that is the question, I would say, of the day, because we have a very similar ranging, but for many more years in long duration US debt. As I pointed out on Friday, or maybe it was a tweet over the weekend, we've been ranging at about a relatively steady interest rate for 1,187 days. So that I find this is one of the more interesting takeaways I find in current data. To me, this implies that the Treasury has been operating on all cylinders and money isn't understood by the majority the way it really needs to be. Ultimately, the Treasury produces a product. Most people think of the Treasury in terms of spending money, printing money. I'm sure they're printing money, but they're not printing it because of spending at the congressional level. Rather, they're printing it because of demand for these products that the Treasury has at a global level. Treasury produces a product and they are meeting the demand. And we could see that. That's the obvious takeaway from this chart because interest rates have been within this relative range for all this time, for years. So most people think Congress comes up with a budget and Treasury fulfills that budget. On the other hand, I think it's the other way around. I think the world demands the product from the Treasury. Treasury comes up with that product, and then Congress has to do something with the money that the selling of that product raises. Talk about a contrarian perspective, huh? So things are not moving from a relative dollar valuation perspective and a long duration interest rate perspective. So what's happening is there's an uncertainty of what's going to play out, where things are versus where things are heading. Although the move indicator, I would say, is still a leading indicator telling us the dollar should continue to go down in 2026 and long term interest rates should roll over at some point in 2026 and come down to a level, I'd say, what, 3.5, 3.75%. We could probably look to 10 years, some technical indicators for some hints. I don't think we get down below 3%. You go out to the 6 month chart, that's cute. The 10 SMA on the 6 month chart lands us at about 375. I think that'd be an interesting regression level. No, 375 sounds about right. All right, 319, maybe transitory, short lived. I wouldn't look to any shorter term time frames. That's just a waste, in my opinion. So I like the 6 month chart. 377 and 319. Those could be interesting targets from a long term interest rate perspective. Um, and that's interest rates, and the dollar is another story. The dollar, I retain my same unchanged opinion from a 6 month chart. We're in blow off top capitulation territory back in H2 2022, second half of 2022, which is going to lead us into a structural reversal of relative dollar valuation, which plays right into Treasury. Treasury is issuing all this product to meet demand of the global Treasury demand, and that's going to result in increased currency supply as the volatility of those interest rates have been suppressed and the euro dollar market considerations. So the world will be flush with dollars, and that means the relative value of the dollar should come down compared to other currencies. So that continues to be my takeaway. I don't think any of the data is contradicting these very simple, I think they're simple conclusions. Okay, so that's the macro update. As per the title of the stream, not much is going on, although everyone seems to think so much is going on. So I think that is probably the most contrarian takeaway I could offer. It's the opposite of what everyone thinks. Let's do the commentary. Maybe we'll keep it short and sweet for today. Arrow, good afternoon. Always a pleasure, my friend. Any thoughts on new YB vaults in progress there? It's brilliant, as with everything that comes out of Michael and Swiss Steak, in my opinion. Um, People and actors will be able to have an uncapped access to yield basis vaults by supplying their own CRVUSD. And clearly, supplying their own CRVUSD means it's coming from Curve. So it has an associated interest rate, either from Llama Lend or a mint, a direct mint. So that sounds great uh, in all regards, right? I don't think there's possibly any negative. That's not coming from the credit line that yield basis has um, with Curve. So I think that makes a great deal of sense. That what we'll see that maybe in a month. Cool. It's very simple. So there's not much else to take away from that other than it has the potential to uncap um, what is currently capped, and that could produce interesting price action and volatility in these LPs. So clearly, my opinion does not change about yield basis. If anything, it's getting stronger as these narrative points and technological innovations offered by the team are just increasingly interesting over time. Good place to purchase YB. Well, good place to purchase implies it's getting cheaper, and it could always get cheaper. Prices can always go down. So my sentiment is I've already acquired exposure at a significantly higher price than where we are currently. There's no other takeaway that I can rationally have. I have acquired my position size. That's it. It's not for me to think, oh, I paid much more than I could have. That's a waste of time and effort. That's not the mentality to have with regard to capital management. The mentality to have is, did you buy the right thing? And did you get a decent price? Now, hopefully I got a decent price. Okay. That that's the variable, but did I buy the right thing? I stand firm that I bought the right thing. So that's cool. That's separate and apart from price action considerations. Peter, much a pleasure. Good afternoon. CVX at 220 while yield basis and curve and AR puking. Interesting. Oh, sure. I mean, it's all part of the same ecosystem. So you're going to have varying price action depending on relative party interest. So at some point, the narrative comes back to convex and governance control and the Berkshire Hathaway of crypto narrative. Come on. It all circles back around. So the Federation is still the Federation, as we've discussed for all of these years. Interesting perspective. It makes more like Congress decides what to do with the dollars raised from selling Treasury, and based on spread revenue, they decide taxes and other. Yes. So Congress is reactionary. It's not like Congress is like, hey, Treasury, we need to come up with a boatload of money in order to fund these things. It's Treasury is coming up with supply to meet demand, and then Congress is like, shit, we got a lot of money we got to spend. That's my perspective on how all of these puzzle pieces fit together. It's just the opposite of what most people think. And anytime I come up with an idea that's the opposite of what most people think, I tend to like it even more. Precious metal soaring means there's going to have to be some global collusion to suppress further price increases volatility. Exactly. Do I do like looking at SPX in terms of gold silver, tell an interesting story. Exactly. So at some point, I mean, look, DTCC and Gensler, they talked about it a lot, and the central clearing of treasuries. The narrative is the same for everything. It's all about suppression of volatility. What do you think the repo market is and the reverse repo market is? It's the largest actor in the room coming in to suppress relative interest rate volatility. So with DTCC and central clearing, they have a capacity to suppress a rapid spike in treasury sales or purchases to suppress volatility. So that's the same thing here, except there's no. So this is kind of like when the global financial system finds its outlet, finds the spillway that doesn't yet have government controls. And this is the problem with central planning. And when you try and control everything, volatility finds a way, so to speak. So there is no levers on gold and silver, and it's probably getting pretty precarious with regard to the bank short positions. So I don't know. I don't know what plays out, but I know this is clearly a spillover and what happens when you try and control volatility. And clearly we have the volatility in silver prices. You have an absolute equities market collapse, which is downright fascinating to watch play out. particularly silver denominated. Gold denominated, sure, but especially silver denominated. Pretty crazy. Will that increase fees meaningfully for VEYB and VECRV? Both. So you're going to get increased liquidity depth at the yield basis level, and you're going to get increased CRV USD supply at the curve level, but increased CRV USD supply that has an interest rate associated with it. So theoretically, as things play out, and as these markets actually become attractive again, because right now this is a full-on depression across the board. Um, this is a mechanism for significant CRV USD supply expansion with an associated interest rate. And as you have more and more liquidity depth in the yield basis pools, you have increased routing towards the pools, which means increased transaction fees. And yield basis does exactly what everyone sees it has been doing since it was launched. It's exactly what you say. So right now they're filling a gap for a supply sink and a means for uncapping yield basis LPs. It's brilliant. It's a brilliant solution to a currently existing constraint, not a problem, a constraint. So how do you grow things? You got to uncap things, and you have to reduce frictions, and this solves for all of those things that we've been observing with yield basis thus far. The biggest observation is that the pools fill instantaneously. So this is a means for uncapping those limitations. What's your take on low CRV APR for base CRV? It's not gaining attraction, although they have built great products. My purchase was based on the three rules. The three rules make perfect sense. How much does it cost? How much is it paying? And how likely is it to continue to pay? How much does it cost? All right, 39 cents, not bad. We could look at the technical details, um, and it'll drive most people nuts. And if it makes anyone feel better, I've bought Curve at significantly higher prices, but it doesn't really play into my sentiment. Did I buy the right thing? And Z is clearly fulfilled. Is it likely to continue to pay? These are deterministic and immutable protocol, so they will continue to pay into the future. And if you're talking about low CRV APR, you got to consider the vote rentals. So the vote rentals are still there. So overall, um, not yield basis monitor, curve monitor. Nope, not curve monitor. Curve hub, probably 8, 9%. Okay, so you're not getting 50% on your money. You're not getting 20%. You're getting 9%. You're getting over double the risk-free rate of return for exposure to volatility. Risk-free rate of return is long-term interest rates, which is about 4.2% on 10-year treasuries. So you get 9.2% here. It's not for me to tell folks that, oh, you should be satisfied with 9.2%. We all want more money. But the reality is 9.2% is an absolute extraordinary amount of money in the grand scheme of things. And my sentiment is this is doldrums. This is us experiencing what a depression is like. So if this is the worst of what the market has to offer and we continue to survive, I look forward to better days. Markets offer us two modes of operation, austerity and prosperity. This is overwhelmingly, unambiguously a period of austerity. When you own assets that produce revenues, you're making less money in a period of austerity. And when you own assets that produce more revenues, that's a period of prosperity. So we operate differently in austerity versus prosperity. When you're making less money, you spend less money. When you're making more money, you can spend more money. So these are the takeaways. Three rules stand, all my rules stand, XYZ, the four rules, and the five businesses of crypto. The biggest takeaway most folks will get from my content is absolute, unrelenting consistency. And that's the beauty of the rules. That's the beauty of XYZ. And that's the beauty of our observation of the five businesses of crypto. They're completely irrespective of market insanity, market volatility, market pricing, and emotions in markets. They're just rigorous, fundamental rules that withstand any inspection or any criticism because they're so generic. They're broad. And that's the whole point. the whole point is to have rules and a framework to engage with a market that is mostly irrational. So you need rational rules to engage with an irrational market in order to maintain sanity and survive. Hope that helps. There's going to have to be some intervention in markets. Absolutely. Stock's not looking good, and most people are paycheck to paycheck. Average citizens' sentiment is very low. Yeah, it's beyond very low. I think this is depression level territory. And inflation's rolling over, what, 1.5% according to Trueflation. And we have front row seats to what plays out. But this is like airdrop territory. That's what they did in 2020. And they're going to have to intervene in the precious metals market. It's destroying the relative pricing of the securities markets, which is the backbone of the economies, global economies. So we get to watch and see what plays out. But intervention is a precursor to some sort of financial system expansion. And we know the MOVE indicator is a forward looking piece of data that tells us um, the market is primed for currency supply expansion once they get volatility under control, volatility with regard to long term interest rates and the relative pricing of currency. And right now, all of that is getting absolutely decimated by the relative pricing of precious metals. So the reason people don't see a crash is because it's not in their face and it's not dollar denominated, but the crash is occurring relative to the price of money. So the world uses treasury instruments, United States government debt instruments as money, but gold and precious metals, silver, are clearly a monetary instrument. So priced in money, securities are getting absolutely decimated. This is by far the only the only way to describe what's going on is an economic collapse right now. It's just that people don't see it because it is not in terms of what means most people inspect and understand. What's the best advice for a 30-year-old? I have watched you for 4 years and got massive amounts of knowledge I could not get from anywhere because we all think different. Thank you very much. It's been 4 years, hasn't it? So 4 years means this has basically been a bear market slash depressionary environment post 2022, which the narrative back then was liquidity crisis in crypto markets and Celsius and BlockFi and all of them, FTX, the entire collapse. So anything that has survived since then is an extraordinary testament to what has been produced. From a 30-year-old perspective, I think the rules are paramount. And the rules being executed are dependent on financial considerations, revenues, how much you make from work, um, and rule number four, for instance, here let's break it down. If you make X amount of dollars from work, you got to respect rule number four: never fuck up the cash position, which means you get let's say $1,000 a week after tax gets deposited into a bank account. You can't spend all your money. You got to balance your budget, which means if you have $500 worth of bills and you have $500 a week extra capital, you can't spend $500 on consumables and investments. You can't spend all your capital because you can't fuck up the cash position. You always have to have some cash because cash affords you a capacity to make decisions. It gives you optionality. But you also have rule number one. It's an absolute requirement to own more assets over time. So the rules go back and forth with one another. There's a synergy, a rhythm to them. So rule number two says, buy stuff expensive. Know when to stop buying assets. All right, well, things are at clearly depressed prices. So rule number one's on the table. And frankly, for a 30-year-old, rule number one is always on the table. So you execute rule number one, not messing up rule number four, respecting rule number two, and strictly adhering to rule number three, in my opinion. But rule number three has a caveat because it's important to own monies. It's important to own collateralizable instruments as well. So it's complicated because it plays into how I define the cash position as Bitcoin and stablecoins. And the whole conversation that could be had is of the whole conversation that could be had with regard to me eventually folding stuff like Ethereum into the cash position, which it still isn't in there for me. I still don't define Ethereum as a cash. Um, so what do you accumulate? What is the priority? You want to have some sort of monies, Bitcoin and stable coins, which is equivalent to basically a bank account deposit in all regards. But you also have to have investments. So you have to accumulate non-monies, and the investments are qualified by rule number 3, and all of that while not messing up rule number 4. So it's an interesting conversation to be had, whether it's between me and you or just everyone with themselves. How do you balance all this? So the measure of success isn't numerical. I find the most comfort with the measure of my success being my adherence to these rules. Don't mess up cash. Got to have cash on hand. Never spend more than you make. Own more assets over time. I bought a clip of Anna from Nirvana over the weekend. I own more assets. I'm not buying things that I feel I have an appropriate position size or are potentially overpriced. So I'm not buying at the wrong time. I know when to stop buying. And all of my chosen investments, not cash position, are respecting rule number 3. It's very hard to tell folks that total net worth is the biggest bullshit that will drive you nuts. A kid saved $1,000 all summer, like say a 24-year-old or a 20-year-old. How do you tell that kid to buy something and then they see that thousand turn into 800 to 700? It's not something easy to learn. But then next summer you make 5 grand and you have X asset, Y asset, Z asset, A, B, C, and now you're building this portfolio of assets. And between 20, let's say age 20 and 30, you have now a boatload of varying assets. And each of those assets have a story, a narrative, and a part in the portfolio for a reason. So over time, portfolios get built, and portfolios are a manifestation of the market telling you what is good and what is bad. Sell losers, buy winners. Portfolios get concentrated over time. And that's clearly a post 2022 narrative where we had all these losers, and we clearly have a different portfolio than we had back in 22. How many things are winners? So we've concentrated, sold the losers, and bought the winners. And the portfolio is what it will be. The market tells us what our portfolio is worth. We cannot force our portfolio to be worth what we want it to be worth. That's what causes the vast majority to fail at capital management. Hope that helps, Ryan. So how is it not overexposure to have VECRV or VLCVX and VEYB? Um, Indirect loose coupling between VEYB and curve federation. It's an additional cash flow. So yield basis cash flows are using technology of curve, but that's a different cash flow. It's a different beast in my opinion. There's potential for yield basis flows to be additive. So it produces more revenues than curve, or vice versa. Cyclically, much like we've talked about VLCVX vote rentals versus VECRV vote rentals, there's a cyclicality to them. Um, Clearly, if a portfolio is capitally constrained, you don't have to own both. You could own just base curve federation, VECRV, VLCVX, and you have exposure basically indirectly to VEYB. And that's basically the same narrative for VECRV versus VLCVX. You own VOCRV, you have indirect exposure to the whole convex narrative and vice versa. So if a portfolio is capital constrained, you don't have to own all of them. If you have extra capital, you have a capacity to make decisions. And I would say if you have extra capital, you're probably considering, or you have to consider position size. You don't want to oversize a position or undersize a position. Now, these are very vague statements. As always, what is a properly sized position? And these are hard things to answer, and I can't answer them for you. A properly sized position is based on sentiment, gut instinct, and how you feel based on the overall composition of the portfolio. A portfolio is in many regards, a craft, sculpture, a painting, a tapestry, what have you, something you mold. So a properly sized position is something that feels right. And when the market's doing well, a properly sized position will do you well. My 2 cents. Hope that helps. Interested to see how new yield basis vaults bring more yield to CRV USD savings. The higher savings rate brings more attention to Curve Eco as a whole. The synergy between yield basis and Curve Federation is maximum. I'm overwhelmingly interested to see what plays out as well. And I think the synergy is couldn't be better. And these new LPs that are coming online make perfect sense to uncap yield basis LPs. And it's going to put bit creation pressure on CRVUSD direct from Curve, which has an associated interest rate. Everything looks good to me. I look forward very much to see how all of these things play out. And I sure as hell know that I want front row seats. The only way to have front row seats is to just follow the 4 rules: own more assets over time, respecting rule 2, 3, and 4 as you're executing rule number 1. Yeah, serious austerity, huh? Okay, so how do I execute? It's not like I'm claiming cash. I haven't claimed cash, I think, in months. Most of it is unclaimed, like Velodrome unclaimed. It's all unclaimed in terms of like Bitcoin, Ethereum, and stable coins. So I'm not going to claim that stuff now. And frankly, I probably should be doing the same thing with Aerodrome. So that's just accumulated USDC from autopilot, but I didn't. Um, so I'm pretty much not claiming at the moment. I'm waiting to claim during better times where the pricing of the assets is more favorable. At least that's my mode of operation currently. Why don't you define ETH as cash volatility? Not that Bitcoin isn't volatile, but Bitcoin's down 0.64% for the day, and Ethereum's down 2% for the day. So Ethereum definitely coming in more volatile, and I want a less volatile asset for the cash position. And Bitcoin qualifies as that because what else am I going to own? What else is there to own as a cash in a crypto portfolio? That's you can't do anything other than Bitcoin as a base component. So anything that you add aside from Bitcoin is in addition to. It's like, all right, this also qualifies as a cash component. So in this case, Ethereum is just increasingly volatile. I think as it gets more valuable, the same thing will emerge where it seems like Ethereum is suitable as includable in the cash position. And that's my expectation. It doesn't mean I have to accumulate it now. Um, that's just my sentiment. A lot of portfolio management is sentiment driven, and the guiding principle with regard to sentiment is are you comfortable? Is it something you can live with? Are these the decisions that leave you without anxiety and you feel like you've made good decisions? And that's the appropriate inspection to make with regard to sentiment. Are you comfortable? Can you sleep at night with these decisions? Amen. How do you define it currently? ETH is just the volatile asset, primarily defined by me uh, as gas token. ETH is required to execute transactions. So with regard to what I have access to, it's just for gas. That's all I have it for. Gas token. So it's very limited. I have very limited exposure to Ethereum. Only what I need in order to execute transactions. And clearly the vast majority of that's on mainnet. So, quarter ETH, half an ETH. What do you need? Not too much. I'm not keeping it as cash. I just need it for transaction fees. So that's its current use case for me. How do you decide where to park stables? I park them nowhere. I don't do anything with them. And in USDC versus CRVUSD. So USDC and CRVUSD, I kind of feel both comfortable with. I don't have any exposure to USDT, which is probably just subjective. But at this point, CRVUSD, I'm quite comfortable with such that with regard to the stable as part of the cash position, I own CRVUSD as well as USDC. It's not like I favor one or the other. Or maybe I do. I actually probably favor CRVUSD because of its determinism and its immutability and its on-chain nature as compared to USDC, which is a centralized product. So I probably do favor CRVUSD more, but I'm just not inclined to adjust the composition towards it proactively. Obviously, the CRVUSD comes in from the ECRV revenues. So whatever is there is there. It's not like I'm adjusting it, dynamically as I favor one versus the other, more or less. Um, yeah, SCRV-USD is fine. There's no reason to have CRV-USD as compared to SCRV-USD. You can park stables in Aave, but most of the time, I just don't care. Like if you get 2.5% on a relatively moderate sum of capital, I don't want to deal with the accounting. So that's probably a big driving factor in my decision making process. Anything that complexifies accounting is evil because accounting is evil. So anything that can simplify accounting is exactly what I want to do. So maybe just naked stablecoins is all you need. Anytime there's interest in volume, what the hell are you going to do? I just don't want to deal with it. Still maintaining the Theta position. Well, it's locked. So can you even exit it? If I could, I would. Whoa, Theta. Can you even exit it? No, these things are locked. So at least they did that right. Not selling the NFT sales and taking a massive haircut. Is there even an aftermarket for Theta NFTs? So it's just, I just don't really care much. It is what it is. It's a write-off. That's a sentiment that I have regarding it. It's the last remaining position of quote unquote like n- uh, uh, the E33 exchanges outside the scope of the aerodromes or the drones. We clearly got rid of all the Kingdom products, and if I could get rid of this without, it's not like it's a large amount of capital. So most of the time, like I don't even care. That's my sentiment regarding it. So it's just off the radar, but it just doesn't do anything. Rewards. Let's see if there's anything. I mean, look, this is an enormous amount of time for these rewards. It's just an enormous, this is months of rewards. So I just don't even care. It is what it is. I mean, at least it offers exposure to Binance, BSC, but whatever. So it is going to be what it's going to be. Sometimes you're able to recoup capital. So I recoup capital. I exited Cosmos Hubs, exited Cosmos, and what was the other thing? Oh, I had some. So Stargate converted to layer zero, so I exited that. I got rid of that. I have nothing left. There's literally nothing in my portfolio that is sellable. There's just nothing that could technologically be sold. And that's exactly what I want from an optimized accounting standpoint. What I want is a portfolio that technologically cannot be sold. And that puts me in a favorable accounting position. Because if you technologically can prove that you cannot sell something, what's the fair market value of it? And that's an interesting, not just philosophical question, it's frankly a legal question. It's accounting question, a tax law question. It's very interesting. Because how is that in traditional finance? Can't prove that you cannot sell something. I mean, a judge could force someone to sell something, but in blockchain and the software, you can technologically prove it cannot be sold from the account deterministically. You'd show that if you try and execute a transaction, no matter who asked you to execute the transaction, it will fail to execute. And that's a fascinating position to be in from an accounting standpoint. With all the regs and bills being passed, looking for Frax to finally give me a fat paycheck. Yeah, I'm locked, obviously. That's one of my earlier lock positions. And I would like that to be the case as well. They've deserved it for a long time. They've built incredible products. They fit squarely into the realm of the best tech isn't always the best investment, but I would hope that they do exactly what I always thought they were capable of. Very much look forward to Frax becoming what they deserve to become. We'll see how Frax works out. Though still locked. Well, you're locked. So that means you have exposure to something that's not, it's not even an investment because it can't be sold. So you have exposure to it. And if it happens to produce revenues, that's great. That's exactly what we're here for. We're here to buy things and own things through the bad times such that we could see what they're capable of during good times. And we haven't had a good time since post 2021. So the last time we saw a good time was 2021. It was a different world back in 2021. And there was no market prior to 2020. None of this existed prior to 2020, ladies and gentlemen. So post 2021 was the market telling us how exuberant things can get. And then everything just started collapsing in 2022. So frankly, we're in a period of where this is like 2019 in so many regards. What survives is going to be just fascinating as the market expands with regard to global currency supply. Just the frenzy in the next market cycle is just going to be fascinating because the frenzy in the next market cycle is going to start with this base layer of infrastructure that has just been time tested and built out during the worst of markets. This immutable, deterministic, utility filled financial infrastructure. It's be absolutely fascinating to watch. And that's worth everything because I remember 2019, I remember 2015, heading into 16. And when that market clicks over and starts firing, it's very interesting to watch it play out. And the next time this market plays out will be unlike anything anyone experienced. It'll be unlike 2019 heading into 2020. Certainly the earlier cycles, which are completely irrelevant. There was no economy back then. There was no economy in 16, 17. There was no economy in 2019. But now, whenever global currency supply expansion cycle commences, there's a full-on financial economy that's frankly backed up by the banks as well as the central bank as well as Congress. Oh my God. This is as I appreciate 134 people on the stream, but this is the time that everyone should be mind-bendingly excited because of what we're about to watch play out. And you just waited 4 years post 2022. It's closer than ever. And the system has to expand. Otherwise, they can't pay tax receipts nominally. So why are they spending all this time on these tax rules for crypto? Are they going to get a bubble in real estate? Are they going to get a bubble in the stock market? They're spending all this time and effort on the rules for crypto because when the bubble happens in crypto, they need to be able to tax it to pay the nominal tax receipts. The narrative remains so incredibly obvious for the next couple of years, let's say heading into 2030. Just so damn obvious. So I sleep comfortably at night, even though there's a great deal of volatility. And as Peter mentions, a great deal of austerity. I look forward to what's coming. Ladies and gentlemen, a Monday, January 19th, 1:25 p.m. I thank you all for joining me. 137 people made it to the end of the stream and are all now that much more rational because of it. Try and keep your heads on during the week. Social media narratives and mainstream media narratives will drive people nuts. Try and peer through the noise, find the deeper narrative, and we'll circle back around towards the end of the week and we'll go over it all. Until then, ladies and gentlemen, peace.